Hey, welcome back to Everyday Economics. This is the podcast which you'll learn about the economic world happening around us every day. I'm your host, Chris Krug. I'm publisher of the Center Square Newswire service. Everyday Economics is brought to you by the Center Square, and we're recording this episode on Monday, March 23rd, 2026. Join me as always, Dr. Orphe Divounguy, PhD economist. Dr. O, um, the Federal Reserve held rates steady last week. No real surprise there. Certainly, not for the people who watch us. But here's what caught my attention: the Fed is now kind of arguing with itself. Chair Powell says the economy is stable enough to wait. Governor Miron saying now that policy already may be too tight and the damage just hasn't shown up yet. That's not a small disagreement. That's a fundamental argument about whether the economy that we're all living in right now is fine or quietly falling apart. So let's get into it. First question. Powell described the labor market as quote unquote soft but broadly unchanged. But he also said that the break even pace of job creation has fallen because the labor force is slowed. So fewer new jobs can still hold the unemployment rate. What do people or what should people understand about what that actually means?
Yeah, let me go back first and say, look, the Fed is not disagreeing with itself, but it's just a board, right? And on the board, you have all these different members, right? Voting members who are essentially um, talking about their observations and presenting their viewpoints about where they see the economy today and how they see the economy evolving, right? And so, in fact, we only had one dissent this time around. uh, we've had multiple in the past, at the past meetings, and so I think a consensus seems to be forming that perhaps it's not going to take a ton of job gains, big job gains, to keep the unemployment rate steady, right? And part of it is due to the decline in the decline in the labor force, in labor supply, right? If the labor force declines, well, the unemployment rate, labor demand can actually fall, and the unemployment rate will not increase all that much. We talked about it on the podcast last week. So the bar, essentially what that means is the bar for a rate cut has just moved a little bit higher. It means that, even if we were to see flat to, no job gains, that means, the labor market is stable enough, right? The unemployment rate is not rising, that we can maybe pay a little bit less attention to the labor market and focus a little bit more on the inflation picture. The inflation picture is not looking great, right? Things are moving higher, not lower. They're not moving towards the Fed's target. And so that has everybody somewhat concerned, especially in light of the latest shock, right?
Yeah.
The oil price increases that we've seen recently.
Well, here's what sticks out to me. The Fed nudged the longer run policy rate up to 3.1%. That's something of a quiet admission that neutral is higher than they thought, which means that when they do cut, they may not cut as far as some people may expect. That seems to me to be a bigger deal than the headline of no change. Am I in the ballpark
I
on
think
that?
I think you are. It's a small change. They see interest rates staying a little bit higher for a little bit longer, right? But you listen to the individual board members. Listen to Chris Waller on one end, Waller, and then Miran, and then a couple of others that are going to be speaking this week. And what you learn very quickly is that they're pointing to housing inflation uh, easing. They're pointing to the fact that non-housing services will tend to follow the labor market. So as the labor market, slows down, non-housing services inflation also slows. And so, you had a series of successive shocks. And, all we really have to do is kind of wait through that, right? We had the tariffs first last year. Now we have the oil stuff, right? Those shocks will dissipate, and when they do, what will happen is everything will ease. How do we know things are likely to continue to move lower? Well, look at aggregate demand. If you look at the housing sector is flashing red, basically warning signals.
Mhm.
Rent growth is easing. It's lower than even before the pandemic and continuing to move lower. Residential construction has been on a decline since last year. New home sales are at a 4-year low. So, you look at the economy, the real economy, and what you see is people are pulling back, right? And if it weren't for the oil prices rising, potentially we'd see inflation moving lower, continuing to move lower, and not, you had tariffs, of course, but now the inflation shot, the oil price shot. Potentially we'd have inflation somewhat stable at 2.7, 2.6%, and moving even lower and closing in on the Fed target, right? So you had a big surge in goods prices in 2025, and that's holding things somewhat elevated for now. But that will pass. That will pass, right? And so, I think the big question is whether the Fed is making a mistake or not, right? Is should we move ahead of all of this, the real economy essentially slowing down? Should we move ahead to try to prevent further deterioration, or do we just kind of wait and see? And right now, it's choosing to wait and see.
Yeah, and I'm kinda stuck on maybe one thing here, right? I mean, stocks fell and treasury yields rose immediately after the meeting, right? That combination typically means the market sees higher inflation, a tighter policy ahead, and weaker growth to come, right? All at once. And I forgive me, I mispronounced Stephen Myron's name wrong. If Myron is right that inflation is overstated, the market isn't buying it. So somebody here is not right.
Well, I mean, again, Steven last month said, he was talking about 4 rate cuts, right?
Yeah.
I don't know. I mean, the market doesn't is not pricing in 4 rate cuts, right? And so, like, maybe 4 rate cuts is a bit much, right? You just have to kind of what the Fed doesn't want to do is have to reverse course. I imagine you put in a couple rate cuts, the economy starts heating up again, and then all of a sudden, you find yourself with uh, a war that lasts longer than initially anticipated. Prices continue to rise, oil prices continuing to rise, going through the whole economy, and then all of a sudden we have a big inflation problem, right? And so perhaps the wait and see approach is not so bad, right? Now the Fed has to be very careful not to wait too long, right? And so it will be interesting to see what Myron has to say this week, when asked about what his statement last month,
Mhm.
about maybe him seeing 4 rate cuts. I'm not sure that I see 4 rate cuts in the current environment. I see some small easing potentially just to prop up these industries that are struggling right now. But I really don't know. I don't see the 4 rate cuts, especially not in an environment where we're seeing a series of successive shocks, and we have to kind of figure out where the dust is going to settle before making any big moves.
Yeah, I mean, the Fed never wants to be embarrassed, right? I mean, so that in all the years that I've watched, the what the Federal Reserve, has either said or done, it simply just doesn't want to be embarrassed. So, but let me kind of frame it this
Well,
way.
I don't know if it's just that, right? It's just so consequential. It's so important,
I
right?
no, I get it, but I mean, I
It
think that
is.
there's honestly that that the Federal Reserve is it's just it for it to be taken seriously, it has to be right far more often than it's wrong.
Yeah,
I mean
and
that
and it has, right? And
but
and
they're
it has.
like I mean, but their precision has to be like baseball umpire like at
Yeah,
home
yeah.
plate. Otherwise, they're kind of a joke.
Well,
So
we're all Monday morning quarterbacks, right? It's
right,
like, it's
which
a
is
very
perfect because it's a Monday morning when we're taping this,
that's right.
right?
It's
So
a very
Powell
difficult job.
But Powell says, we can afford to be patient. Patience has a price tag. If you're carrying a credit card, trying to refinance, trying to buy a car, trying to buy a home, every month that the Fed waits costs real people real money. So, what does that patience actually look like in household terms right now?
Well, yeah, of course. I mean, I would say the cost is really, if the labor market uh, basically breaks, and the unemployment rate starts to rise and people start to lose their jobs, that's the real cost, right? And we're not seeing that yet. Layoffs haven't risen. The unemployment rate's pretty steady. So we're okay. We're okay for now. And now, of course, you mentioned the fact that rates remain elevated. Look, the reality is that if the Fed were to try to cut in an environment where prices are rising due to either goods prices or due to the oil shock, right? The yields would go up. The markets would actually
Yeah.
punish the Fed essentially because yields would actually go up. And so cutting in this environment could potentially have
Well,
this unintended consequence of doing the opposite of what the Fed actually had intended, right? And so that's why I say, you got to be careful, right? We know the current administration has been pushing for rate cuts, but if the market doesn't buy it, right, then yields could go up, right? Remember, we have a rising fiscal deficits. That's not gone away,
no.
right? We have rising fiscal deficits, and so that's still somewhat of a problem in terms of the inflation picture. Uh, the household sector is has slowed tremendously, but the government sector is still spending, and so if you're spending, if you're deficit spending, that's a problem. And so if you're in an environment like this and you have a series of successive price shocks, and you decide to cut four times, like Myron suggests, perhaps you could end up with the opposite of what you wanted in the first place, which is basically yields rising, credit card rates increasing, mortgage rates also increasing, right, and hurting the household sector even more.
Yeah, well, good points as always, Dr. O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics, where great podcasts are hosted. Make sure you read Orphe's column each week in the Center Square and across the Center Square Newswire. And listen to Orphe and me every weekend on the Center Square Radio Hour.